Welcome to the OPEX Effect, a joint podcast from Excess Returns and Spot Gamma, where we take a deep dive into the world of options and the flows they generate in the markets. Join Brent Kochuba and Jack Forehand every month on Options Expiration Week as they look at the major developments in the options world and how they impact all of our portfolios.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital.
So, Brent, I feel like we've been talking about low volatility forever, but I think this week we get to take things up a notch.
We do. It was a wild week last week. Things are tentatively calm because there's a lot of stuff coming up that could move markets. And you and I were just talking about the last few episodes we did was all about the bizarre low volatility, high correlation regime. I was looking back. We did a April 2024 podcast or episode about volatility suppression and all these flows that are keeping markets down. Then we turned to volatility spasms in our last OPEX conversation. And you know, that all seemed to come to fruition, or the unwinding of those trades all seemed to come to fruition here this last week.
Yeah, I've got my Brent Kochuba emergency podcast indicator. I believe I saw last week you were asked to be on a couple emergency podcasts, so I know it's time to pay attention. When I start seeing you flashing with the emergency podcasts, I know I got to, pique my interest in what's going on.
Yeah, there's a good amount of that. It's funny because we're like banging the drum on this stuff. I feel like, and we were saying, I think last month, July OPEX was one of our longest episodes ever because there was so much to cover in terms of the anomalies in the market. We're going to cover some of those as we come up here, but there was so much to cover, and we're sort of like boy who cried wolf or something like that, or like crying over here, like watch out, everybody. And that doesn't get a lot of attention until stuff breaks, and then everyone wants to talk about stuff after it's broken. So here we are.
So we're going to get into all that today. We've got a lot of stuff to cover, but first we always like to talk about the OPEX cycle and how it works, because that's really important as we analyze these things.
100%. And so obviously we're doing this podcast today, the OPEX Effect, because we have Friday options expiration, and then we have VIX expiration, which follows next week. And so we want to talk about some of the short-term impacts of that, as well as just the general options flows that were a big driver of volatility this past week. So the way that we look at things here, just as a primer, is into options expiration, which occurs the third Friday of every month. We see options positions build up, and the hedges associated with those, these are market maker and dealer hedges, those build up as well. And that can often drive price action. And that's either expanding volatility, i.e. making markets move more, or sometimes we see a pinning effect into options expiration as well. And then when we get expiration, positions expire and the hedges associated with those positions unwind. And so that's why we watch this cycle so closely. These red X's all mark options expirations. And the reason we show this is because not every options expiration matters all that much because positions aren't that big, but there are certain expirations and we measure them in terms of their size of either gamma or delta, occasionally vega as well. But you can see that there are significant turning points, historical turning points in markets associated with options expirations, which are denoted here by red X's.
So on this next one, the zone, this is interesting because we've talked about these zones a lot, but it seems like these zones might be more important now, given we've got some volatility coming back into the market here.
Yeah, that's right. And we watch these zones because these are transitions between what we call positive dealer gamma positions and negative dealer gamma positions. And we have a few visuals in the following slides to explain this, but the zone right now is 5,300 to the downside. That's a support level that if that breaks, then expect volatility to rear right back up. And then to the upside, we think that there's a lot of call selling. I'm going to detail this later in the 5,400 to 5,450 area. So above this zone is where there's a lot of positive dealer gamma, and that matters because dealers are going to suppress volatility up there and slow market movement. Whereas to the downside in a negative gamma environment, they're going to sell futures and sell stock. And so that's why if 5,300 breaks, we could see volatility really pick back up. Now this zone shifts often. It's going to shift a lot here this next week due to both a lot of data coming out as well as options expiration. So we watch these zones and they really helped us to navigate this market volatility of the last 2 weeks. So specifically this idea of negative dealer gamma. When that hits, dealers start selling futures, and then we get a lot of volatility and movement in markets. And then now that we regain 5,300, volatility's come in a little bit these last few days.
When did we go negative gamma?
It was the week before last. So right after July options expiration, we broke 5,500, and that's really what onset volatility. And that happened mid last week, Wednesday or Thursday of last week. And then Friday, things really started to fall apart, right? And then it was the weekend where we had the yen carry trade trigger a bunch of other volatile moves. So we went from 5,400 down to 5,100. That's about a 4% decline, somewhere in that neighborhood, over the course of about 2-3 sessions. It was a very quick kind of vacuum down.
And I know in periods of negative gamma, volatility is definitely higher. I know that's been shown. How about like downside? I mean, does the market perform worse in periods of negative gamma?
It does. Well, what's interesting, an interesting feature about this market, and just to jump to what you're talking about here, Jack, this x-axis is our measurement of dealer gamma as an index. And so the more gamma we have, the more positive we are. You could see volatility, which here is measured as 1-day S&P 500 realized vol on the y-axis. The more gamma we have, the less volatility is in the S&P 500. We're in this negative gamma regime now where you get much larger and wider swings in the market. Now, as a function of the fact that this market always seems to mean revert and always ends up going higher, we just came off of all-time market highs. To answer your question, we generally do over some time frame recover, right? But the onset, when you break into that negative gamma territory, you always get a big drawdown just as a function of positioning. And that drawdown can be, oftentimes very violent. And the recovery period can vary a little bit, but historically, if you look back, 5 days, we tend to recover the bulk of losses. But it's a tricky thing to measure, right? Because the market just continues to make all-time highs over some time frame. So if you look forward enough, we recover.
So the big risk with the negative gamma seems to be pretty closely after it happens.
Yeah, when you break that, you get that initial drawdown of decline in volatility because dealers suddenly have to start selling futures as market goes down. Volatility increases, and when volatility, i.e. implied volatility increases, put values increase. So there's a double whammy here of when prices go lower, market makers who we generally consider to be short put options. If you're short a put and the market's going down, that's bad. But if you're short a put and the market's going down and vol is going up, implied vol is going up, that's like a double whammy, right? Because puts start to really gain in price. And then what we look for is a time period for that pressure to be relieved. Generally, very, very often that comes into an options expiration because a whole bunch of puts will be removed from the marketplace, right? And then suddenly dealers don't need that short hedges anymore. So that's why when you look at this chart, for example, in March of 2020, the low of the market came the Monday after options expiration. You can look in more recent periods, there's a ton of recent periods as well, where significant lows like in 2022, as well as last year in 2023, we hit these lows in the market that come with puts being cleared out, and then the market recovers after that.
So I skipped a slide here. We're going to talk about the August OPEX, and one of the things I try to think about with these is, like, first of all, how big it is, but second of all, have we had a major move into it? Because those two things tend to tell me what we might be seeing, but you can tell me what you're seeing here.
Yeah, you're exactly right on that. What's interesting about this expiration is not particularly large. So this is put delta in blue, put delta in blue, and call delta in orange. And we're currently, half of the size of what we see for September expiration. September's a big quarterly expiration. So this is not a particularly large expiration. What is most interesting to me about this is that we had this crash, and usually when you have a crash, that will charge up put values into an expiration. But in this case, you can see that the call and put deltas are pretty neutral, or they're the same size because the market's rallied back pretty strongly this past week. So puts got cleared up very quickly in this past week, and we're in this kind of no man's land in mid 53.50 in the S&P, where I think the easy play of mean reversion that already ran its course, and now we need to look at forward data to figure out what happens next. So again, very curious that puts are really wiped out here, and we're very neutral into this expiration.
So does that reduce the chance that it's a turning point because we got that rally back already that maybe you would have expected might have come at OPEX?
I think that's totally the case here. We will always, again, bang the drum when we think, hey, there's a big options position here, or it's skewed one way towards puts or calls, as that can be a really significant turning point. We'll show some data there. But this is very, very neutral. And then we have PPI this week, CPI this week, retail sales, and then Jackson Hole immediately next week. And so, this is a less obvious turning point here due to some of these macro events that are coming up.
And so in this next slide, you get into this idea that, often these are turning points. 2/3 of the time, S&P performance flips after OPEX.
Yeah, and there's a big difference here between if VIX expiration occurs before or after options expiration. So if VIX expiration occurs after options expiration, you would see 68% of the time VIX, you get a market flip. So if the market is rallying into OPEX, 68% of the time it will sell off, and vice versa. If the market's selling off into options expiration, 68% of the time it'll turn and rally on a 1 week basis. And that turns to only 58%. So there's a 10% difference there when VIX expiration occurs before OPEX. So in this case, VIX expiration is after equity options expiration. So that falls into the 68% of the time camp. And so I just want to look back quickly and to show the importance of VIX expiration. In this case, this is just the S&P 500. And you can see into July, VIX expiration happens at 9:30 in the morning at the cash market open Eastern time. And you can see that the market high was right at VIX expiration at 9:30. And then we sold off rather sharply to July equity OPEX. And there was a brief rally for a day or two after that. And then the market, really fell apart after that. So this didn't hit, check the box of a full 1 week reversion. You can see we got a very short-term equity OPEX related bounce here after July, but we've sold off really rather hard. So in this case, VIX expiration is after August expiration. So the stats are that we'd expect mean reversion here, which in this case, it seems like we're possibly rallying into August OPEX, but that's heavily related to the data that we're getting in this upcoming week.
So as we move on to our projections from last time, I mean, you saw a lot of weird things going on that you thought might be warning signs in terms of what might happen.
Yeah, so we like to start with the review to keep ourselves honest here. And this is a tricky place to discuss the review because we had this, it wasn't a black swan, but it was this unknown that, no one was looking for in the form of the carry trade, which triggered a whole bunch of things that we were watching to kind of break. So our key takeaways, the quick ones were, we were talking about how overbought the Russell complex was, a small cap summer, and everyone was like super excited about that trade. And we saw record call volumes. And this was all triggered by the CPI, I believe it was on July 11th. If you remember that suddenly, and you can see on this chart, everybody just piled into small caps. It's this blue line here. And what was interesting is, you see the NASDAQ had outperformed the small caps so heavily into this period. And then all of a sudden one day it's like small caps just caught up, and that was the trade of the summer. Well, that obviously exploded over the last week, right? And so, there were signs that Russell was overbought. Whether or not it would have sold off anyways, who knows? But our other big view from July OPEX was, hey, Tesla's really quite overbought. That came down as well. Again, given the context of everything that happened, who's to say what would have happened if we didn't get that yen carry trade unwind?
On the small cap stuff, like how much of that is options? Like that was a really, really massive quick move in small caps. And I'd seen some people on Twitter talking about, it wasn't people buying the individual stocks, small cap stocks. It was people buying things like IWM. And that was then driving up the price of the individual stocks. But like how much of that is exacerbated by options when we see something like that?
Yeah, it's an interesting point, Jack, and I flipped forward a few slides because we saw the largest ever call volume in the IWMs. This is ever right around that July 11th or 12th period. And so if following the way that we look at markets, if you have everybody buying calls, and this works for GameStop as well as, NVIDIA over the summer, right? When you have everybody buying calls and dealers and market makers are then short those calls, they have to buy stock in order to maintain their hedges. And so, I don't think that, there were fundamental people looking to buy small cap stocks. That became a trend on Twitter you could watch. There were a group of individuals who actually got fairly nasty behind their position, which was also a signal that it's probably overbought. Small cap summer was a trade, but then you toss on a ton of calls, right? Millions of calls. And that makes the move, that exacerbates the move, right? Exacerbates, in this case, volatility to the upside. And then we could see in the signals and implied volatility signals that these were extremely overbought, such that if you were started to buy calls, the odds are you weren't going to make money, even if you were correct that IWM was going to go up, right? Because the price you're paying for those calls is just too high. And so, the warning signs were all over on this. And our view was, hey, look, this is short-term overbought. And so we were looking for a pullback and then, the move to restart, right? Because that overbought condition had to wear off. Again, I don't know, suddenly everyone's looking for a recession here, and there's a lot of other stuff that's happened in the last week. So I don't know if the rip part of our view will take place here. But the pullback, the stars were there. But to your point also, I would say that this volatility that we experienced last week was also exacerbated by options market movements and positions, right? And we're going to talk about that. So you see this occurring all over the place, where options are oftentimes a driver, and if they're not a driver, they are making a small move a much bigger move because of the positional effects.
Yeah, I've learned to never be the guy on Twitter touting the small caps when they rally, because we've had so many false small cap rallies over the past decade that often they don't follow through the way we hope they would.
Yeah, and what's funny to me about it is we posted a lot of content about how we thought small caps were overbought, and you can see that in our previous presentation we did a month ago. Just on the basis of these implied vols, and there's no guarantee in anything, but you can tell when a bet is in your favor or not, and when vols are very high and prices are very rich on the options front, that's oftentimes a signal that, hey, like we're overdone, we need a time for cool off. But I also learned when you post something on Twitter and you get a lot of people attacking you for those views, you're probably going to be right. I mean, sometimes some views are pretty out there, but if you're just going like, look, this is the highest implied vol we've seen in like 5 years for calls, and people are like, you're a jerk for saying that, then you kind of, you can kind of start to understand what's happening.
So I skipped ahead again. You had this correlation spasms,
Yeah.
which was basically the main topic of our last episode.
Yeah, and the reason that I'm bringing this up, and I'm not one that likes to, to say, hey, we were right about this, like, just kind of go to overhype that view, right? But the point about this is that if you were watching this stuff and you were aware, I think it made everything over this past week make much more sense in the moment. If you knew that the last few episodes were called correlation spasms, because we started to see this with things breaking in terms of, on this chart here, this is from our last episode. The purple line here is the Dow, and then in the orange is IWMs. They became inversely correlated to the spiders and the Qs themselves, right? So we saw the equity market in a way breaking apart. When everyone dove into small caps, for example, suddenly the Mag 7s and the semis started to sell off sharply. So you had QQQ and spiders down while IWM was ripping higher, right? We saw the equal weighted spider ETF, the ticker's RSP, that became inversely correlated to the spiders itself because of the concentration in the market and these options flows and everything else. And so if you were aware that this bizarre positioning was in place, and then you see all of a sudden this violent unwind on Monday, I think it makes it much easier to go, okay, I understand these positions that have to get unwound. This is not about a recession or the end of the world or, whatever else it may be. I mean, you have people like the professor calling for 75 bip emergency rate cut. And you're like, hey, I don't know about that, but I do know that what you're seeing on your screen is probably, a levered outcome of some short-term flows that have to get unwound.
So in this next one, we had looked at the potential paths that could happen, and I'm not the smartest guy in the world, but I think we got path 2.
We got path 2. And, the trick here is that we didn't know what the trigger was going to be, right? And if you look at what I outlined as triggers, I did not have, as the saying goes, I did not have on my bingo card yen carry trade unwind. But I guess that sort of falls into the bucket of rates increasing. I mean, they didn't increase rapidly. It was like a threat of I think 25 basis point rate cut over there. Doesn't matter. The point is that we got this trigger that meant that correlation was going to unwind. We're going to talk about that in a second. And that is generally associated with the vol shock, as we're going to show you again. So this was the final slide of our last presentation, which again sort of forecasted, hey, when we get a trigger, this is what is very likely to happen. So, Jack, you and I were talking just before about, I think last OPEX was our longest episode ever because there were so many bizarre moves. And so I'm going to very quickly just remind everybody all of the strange stuff that we saw last month. So I know it's about 10 slides, but we'll go very quickly through this part just to remember where we were. We talked about record IWM call volume. That's here in blue. By the way, if you go to spotgamma.com/OPEX, you can download this slide deck, as well as a spreadsheet for this upcoming expiration. So if you're interested in that, and I think, Jack, we can probably include that link in the episode notes as well. Anyways, record IWM call volume led to the IWMs becoming uncorrelated with the other position or other equity indexes. we had major lows in equity realized vol. This is specifically the S&P 500. And so in green here was 1 month realized vol in the S&P. We got like a 6 to 7% there. That's the lowest. We neared that in 2021 a little bit, but you really got to go pre-COVID crash to get this type of realized vol. Markets really weren't moving at all on the S&P 500 side. We had the most overbought reading ever from the Russell 2K. This is a purely technical indicator, just backed up what we were seeing in the options market. This was from Bespoke. You can see that was on 7/16, the day before options expiration. Remember this famous chart? We pioneered this one. We had the most number of days without a 2% one-day loss since the Great Financial Crisis. It surpassed Volmageddon. We have also, there's a little asterisk to this, but we've gone a long time without a 2% one-day gain. I checked the chart this morning. We still haven't had a 2% one-day gain, even though we had such a big rally this last week. The reason that this matters is this is part of volatility suppression. People selling calls and dealers selling futures into that, not letting the market rally too fast, the S&P rally too fast. So
Just as an aside, we actually used your in our excess returns episode today. We used your no 2% loss thing, and we actually credited you, which I think is a rare thing because I think most people just take it and use it. So
yeah, they've updated themselves and showed up everywhere. So good for those getting attention for that. So the lack of a rally, which you never get with those other charts, is also a function of what's been happening, right? Gamma suppresses rallies and also keeps the market from falling too fast. What else did that mean? Record low correlation. So implied correlation, this is the SIBO 1 month and the SIBO 3 month correlation. So they look at options that expire either 1 month or 3 months in time. They hit record lows, so below 2017. And what this was telling you is traders were expecting more single stock movement relative to the index, and that view got extreme. Now, just a moment on this correlation trade. There's the kind of explicit correlation trade, which is traders using options to express this idea. There was also, the idea that people were chasing small caps, right? Not too long ago, we had the NVIDIA call complex be larger than the entire rest of the call complex for the U.S. options market.
That's reversed, I assume.
I'm sorry, say that again, Jack.
That's reversed, I assume.
That's totally reversed. Very quickly, you had the 3X NVIDIA long products. It was a semi-cap chase, and that is, in a way, part of this correlation trade, right? It's just everybody focused on one sector. Then that focus switched to small caps, right? And this matters for our punchline here when we get away from, or when we end this. Get away is funny. When we roll to the end of this presentation, I'll talk about why this matters a little more. But the correlation trade, in my view, is over now, and I'm going to, again, talk about that shortly. Remember breadth, most narrow breadth we've ever seen. We had the NASDAQ and the S&P, 20 to 25% of those indices were 3 stocks, NVIDIA, Apple, Microsoft. That's now closer to 15 to 17%, so it's still high in our view. But, that has come off of this major high. This is a chart of correlation related to the VIX. So if you go back to that pass forward thing, generally, the way that this breaks or unwinds is correlation jumps higher. The reason that correlation jumps higher is because all stocks are getting sold off, at which point the VIX generally almost always spikes. So we've talked about 2020, the greatest depiction of this, because all stocks got sold when the COVID wave hit and everything was getting shut down. So VIX goes to 80, correlation goes to 1 because people are dumping out of stocks to try to save their to go into cash. Interestingly, we're talking about how call heavy the put call ratio was. So this is the lower this goes, the more calls there are relative to puts. And into June OPEX, this wasn't the 2021 style meme mania because breadth was much more narrow here and we didn't have those meme stocks getting so much call attention. But we were at multi-year lows, as you can see here, in the put call ratio. So again, calls were dominant over puts in a major way.
Do you have this? You may have this later in the presentation, but I assume that also is reversed.
100%. I got a nice chart on that.
Okay, we'll do that later then.
I won't disappoint you, Jack. Record low short interest, which I thought was interesting, just to mention that one. This chart from the SIBO showed how single stock volatility hit a record high versus the indexes. Obviously, this is now switched. And then finally, one of my favorite punchlines here, because we're going to talk about the VIX shortly, is this chart is from Nomura. They showed that the beta of the VIX to the S&P was at the 0 percentile. So essentially what that's telling you is the VIX was no longer responding to whatever it is that the S&P was doing. Obviously, most of us know that when the S&P goes down, the VIX tends to go up and vice versa. And that's because VIX is priced off of S&P 500 index options. And so, there's this link between the two, which means that they should really be related to each other. But that had stopped to really function in a normal way, as you can see on this chart. Very rare to have this, this type of rolling beta so unassociated with the market. And then lastly, we talked about this idea of choosing your weapon wisely. And what that really meant was, this was a year-to-date chart, and I updated this. But if you are invested in the Qs, you had a great year. You're up 22% into July OPEX. That's not the case anymore. We updated this. Spiders were up 16%, but the Dow and the IWMs are only up 2 to 4%, right? So you had this big dispersion in performance. If you were long tech and semis, that was awesome for you. You're doing great. But if you were long small caps, that didn't really work out all that well, right? You had this major issue. And so, sorry, I had to dump my Apple Watch there. I was making too much noise. You had this dispersion in performance. And this was a function, again, of the momentum chase. If you were falling behind in your equity performance as a manager, you probably had to allocate more to the NVIDIA to try to make that up. This idea of which sector you choose, I think, is changing going forward. It's going to be more about, do I own equities or do I own bonds or cash? So that was a review of all the bizarreness. There was a lot of other charts I left out of there. It was just, we can watch the previous episode, see how crazy all this stuff was. So we'll flip to August now. Let's talk about this last week. We had a major drawdown from July options expiration. Some may find that coincidental, right? But VIX expiration essentially marked the top at July OPEX. And then down we go. And I drew these little lines in here. This is VIX in red and S&P in blue, because going into where we were Thursday into Friday, this is now a little over a week ago, we've now recovered those gains, right? S&P is now rallied back to 5350, which is where we went into Friday, August 2nd. Roughly that's where the S&P was. And the VIX is back down to 20, which is roughly where the VIX was headed into that event. Because of these data points we have coming up, specifically here, I'll pop forward a few charts here. You can see we have PPI, CPI, retail sales, all starting on Tuesday tomorrow. That's going to keep equity implied vol elevated, right? Because we have these data points and traders are trying to figure out the path of rates going forward. So the reason I interject with that now is because VIX, the easy mean reversion play, is now over. It wasn't necessarily, it wasn't guaranteed that VIX would mean revert, even though that was a very popular trade. And that's obviously because volatility often mean reverts rather violently. But the easy money of that trade has been made. Now it's about, hey, volatility is going to be controlled by these data points coming forward, as opposed to the settling of the flows that occurred the last week. So in my view, we're done with what happened last week. That's now not a function of how the market is going to operate going forward. Correlation, it spiked higher. You can see here we went on the SIBO index from under the 2017 low. Now we're about 25 on the SIBO index. Look, we're still pretty low relative to where we've been over the last 5 to 10 years, 5 years. So correlation can continue to increase, and I think it's going to. I just don't think it's going to have necessarily as massive of a one-day move, right? Like this vol shock that created this. And you could see that the VIX spiked exactly with correlation, because suddenly everyone was dumping equities, whether that's because the yen carry trade unwind or some of the other flows that we mentioned break, or a combination of all those. Obviously, these two are very heavily linked. And so if we do get another drawdown in the equity market because of some bad data coming up, correlation is likely to continue to go higher as well. This dispersion that we talked about between the QQQ performance and spiders, et cetera, you can see all of a sudden now IWMs are up 8%. This is a little over the past year, but they really all closed the gap, right? And what's interesting is you could see that Q, spiders, IWM, Dow, everything just crashed last week, right? But before the last week's crash, suddenly that performance difference really started to narrow quite a bit. Who knows, if that's going to continue. I think if we are in a recession, IWM and small caps are going to have our time. And then when we have NVIDIA earnings coming up, if NVIDIA pulls another, three bagger out in terms of earnings improvements, then who knows what happens, right? We could see that QQQ spider start to really outperform the IWMs again. Of course, if we get a recession, then maybe all stocks just go down. So it's a tricky environment going forward.
It is interesting as we work through like all these weird charts from last time. I mean, basically every single one of them is reversed.
Yeah.
So like all those weird things we saw that were kind of outliers have gone back in sort of the more normal direction.
Yeah, and what's interesting about this too is if you look at April, we had a correlation spasm, we called it, and that was the S&P went down 5%, Nvidia went down 20% in that period, and that trade, retrenched itself and then expanded again, right? As you can see here, and so the difference here is that the market, and I have a slide on this, is pricing in a rate cut, 100% chance of a rate cut in September, and so the macro conditions, in my view, have changed a lot from where we were in April. And that's why I'm not so sure that this trade immediately just kind of rolls back into the way that it was.
So this next one is what I'm excited to talk about because everybody was talking about the VIX spike above 60. It happened very, very quickly. What was your take on it?
Yeah. So what this chart here shows is it says variance premium, but all this is showing you is the VIX index minus S&P 1 month realized volatility. So the VIX is a measure of S&P volatility looking forward. Compare that to what has happened in terms of volatility. And you saw we had this incredible spike on this chart showing that the VIX jumped a lot relative to realized vol. And that only matches a few periods back in, 2020, 2021. And so the argument here that a lot of people are making is that that VIX 65 print was noise. And that was contributed from several factors. So VIX hit 65 pre-open on Monday, the 5th. And the argument is that that was because of, the VIX essentially broke. And our view of this, and we did a live Q&A, you can see it on our YouTube channel, did it with our partner Imran. And, the VIX is a product of S&P 500 index prices that expire 30 days out in time. And so what happens in these environments where liquidity is very poor, the options bid and asks widen out, right? So instead of the market being $1 at $1.10 for some random S&P option, suddenly that market goes 50 cents at $5, right? And when that happens, the implied volatility of those options is higher because the bid and offer is way much wider. And so the options that are going into the calculation of the VIX are much higher in implied vol terms and in real price terms, and that makes the VIX index jump. And so a lot of the vol traders on Monday morning were saying, hey, you can't trade that 65 VIX. And, what they're saying is, the VIX futures are quite a bit lower. The VIX index itself is as this artificial high because of a function of the lack of liquidity and the poor quotes in the market. And you can't actually put off a trade that's based on that 65 VIX level. On the surface, I agree with that. You couldn't get a fill in a lot of these products, right? In Monday morning at 8 a.m. It was very tough. So I think the VIX calculation was what it was. If you want to throw a flag out and say it's exacerbated by this liquidity situation, I think the liquidity situation is real. The fact that liquidity stinks and and that led to this incredible VIX price, that to me is a real manifestation of the risk in this market. And I'm going to talk about that in a second. The other thing is, and we put this on our Twitter feed, and there was a Bloomberg article that we were in about this, is that there was a very large VIX cover trade right at the VIX as the VIX hit 65. And we saw the VIX, I believe it was the 30 strike calls for August. Those appeared to be getting bought, and those were deep in the money calls. I think that was a margin call. And so the fact that the VIX had hit this high at the exact same time this very large trade was going off told me that as soon as the market knew that this person was covering, they widened their bids and offers out even larger, right? It's just like margin call or Wall Street or whatever other movie. When you know someone's in pain and covering, you got to widen that market out. You also don't want to wear those trades, right? You don't want to necessarily be buying VIX calls at the high. So you widen your market out, and that one person had to cover. And as soon as they covered and the cash market opened, that the market, the VIX really, declined rather sharply.
So the two arguments I've heard is one, the VIX never hit 65. And two was it hit 65, but you couldn't have actually shorted it, volatility there. So
yeah.
You think the VIX did hit 65. You think the calculation was correct, but there is merit to this idea that, you couldn't have actually shorted volatility up there.
Yeah. And I mean, the function of the market or of it being correct, right, is in a way, they're sort of linked. I mean, these bids and offers widen out, liquidity stinks. So like when you're trying to quote the VIX and gather up all these options prices, it's not this clean pricing surface that you get to use, to put into your calculation. It's sort of like, if you remember, like in the 1987 crash, I mean, you and I were both a little too young for that. Like you couldn't, or a flash crash or something else. A lot of a lot of components of the S&P 500 don't open, right? It takes them a long time to open. So you can't really get a clean calculation on what the S&P is, right? So it's a sort of a similar environment where you go like, well, did the VIX really hit 65? Well, the VIX is just this index of S&P prices. So the fact that you're having these weird calculation problems that gives you this bizarre number, to me, it matters because it's a function of how messed up the market is right now, right? And anytime you have bids and offers widen out, well, if you want to make I guess what I'm trying to say is, if you're going to make the argument that the VIX calculation broke or that wasn't real and it's only off of traded prices, then the VIX probably doesn't have a clean calculation ever, because there's a bid and offer every day, all day long in the S&P 500, and sometimes those markets are wider than where you can really get filled, right? So maybe someone needs to create a traded S&P options VIX index or something, like, okay, this printed, so we'll use that for the VIX calculation. I don't know.
So this next slide also gets to something I've seen a lot on Twitter, which is this idea that liquidity is just really terrible right now.
Yeah, this is E-mini futures top of book liquidity. And so, this is a 2-year chart from Goldman. You can go to the CME and get the similar chart, but in red here, you could see the top of book liquidity just evaporated. So, if you go down 2-3 levels deep in the order book, it's not maybe quite as significant. But the point here is that, look, we just mentioned the VIX calculation broke because these options markets widened out. This is a function of that, right? Liquidity now seems to evaporate faster, than I've ever experienced in my life. I've been doing this for 20 years. And a function of this, I think, is how electronic markets are now. I think that, the market makers and the dealers of the world are very, very good. They can widen out and disappear when liquidity is not available. You also had a lot of the retail brokerages go down the morning of Monday. So I think that affected liquidity in ways, even though the retail component isn't a huge E-mini E-mini futures user. There was just those problems, linked. And obviously US market volume ripped because you have the situation where there's a lot of forced trading, right? Whether it's unwinds of, yen related carry trades, the options flows that we're talking about and the underlying hedges, like there's people who are forced to trade in those environments, which are, either explicit or implicit margin calls taking place. So people have to trade, and they have to trade at a point where bids and offers are widening out and liquidity evaporates. And when that happens, you get extremely volatile events like, what happened last week.
Does the fact that the major market makers dominate the market, does this contribute to this? Like, to the Citadels of the world, if they decide to back off, it can have like major market implications?
That's a fantastic point, and it's one that I hadn't brought up recently. I think you and I have talked about this in the past a little bit, but there's 5-ish major options market makers, and the options market's gotten so large that the liquidity is just rests on the shoulders of really just a few players here, right? And it's so hard to get into the market making business now because the technological moat is so big, the legal compliance moat is so big, the capital requirements are so big that you have both your arms tied behind your back, and then you're going to go into the arena of like Citadel and try to quote better prices than them. I think it's just extraordinarily difficult. And so, this is an issue where if they just, Citadel alone decides to widen their spreads out, and this is not to say anything bad about them, but if they just decide to widen that's like 40% of the options market suddenly is kind of like, gone away a little bit, right? So the options market by and large did function okay. I think the brokers had a bigger problem here in terms of connectivity and things like that than maybe the market makers did, but they certainly widened out, right? The market certainly widened out.
And how was it? I'm just curious, like, how was it with like trading? I don't know if you were trading on Monday morning, but I remember Andy Constant had put something on Twitter, basically like based on the spreads he was seeing in the options market, like he hasn't thrown his phone in many years, but he would have thrown his phone Monday morning. Because I guess things were pretty bad. Like he was having trouble getting fills on anything.
Yeah, I was fortunate to be, have some long VIX ETPs in my portfolio. And those markets, those markets are wide, generally speaking. They were ridiculously wide on Monday morning. And so, I definitely got a fill that I didn't love. And, your P&L is moving around a lot. I did get a fill. I was happy to get liquidity there. I was happy to be able to log into my brokerage platform and to get a fill. So, that was fine. But if you're trying to manage a large book, where you have tens of thousands of contracts have to get out of, you probably, were really struggling on Monday morning into the heat of the battle, right? It's one of the small advantages retail traders have, I think, is like, hey, if I can get out of this 10 lot, I'm pretty happy. And I could probably get that liquidity, right? Even in the death throes of Monday morning. But if you're long 10,000, like you're probably just holding those and good luck to you, getting a fill then.
So this next is really interesting for me because we've been talking about the rise of zero DTE volume almost every episode. And now it actually went the other direction.
Yeah. And there was a good article in Reuters about this. I had actually not realized this percentage dropped so sharply on Monday morning, but you can see it was about 25%. And this is the SPX zero DTE volume percent. And it that's a significant low. This is Christmas Eve here is a previous kind of weird low that you see. So, kind of a holiday effect. But in this case, related to, bids and offers not being there or being very wide, related to volatility spiking so much, which brings attention to longer dated options, related to these brokers not really being open. A lot of them weren't available for the first half of the day on Monday. And then I also think related to the fact that these correlation trades broke down or had to be unwound, I think a lot of zero DT volume is based on buying and selling, short dated, say NVIDIA or Apple options, and then selling or trading S&P zero DTs against them. I think that's a big trade. And that became under stress. And so I think those trades just get turned off, right? The HFT shops just shut it off because the market's not doing what it normally does. All that stuff sort of combines to having a record low zero DTE volume percentage, right? And you're going back to the start of zero DTE here when you're getting down under 30%. There's some other people who say, look, zero DT just didn't function. Like it was just like shut off in the morning. I saw zero DT trades going up on Monday morning. So, you can take that for what it's worth. The takeaway here is that zero DT liquidity evaporated kind of, I think, when a lot of people were thinking it would maybe be a significant driver.
Yeah, and I would think if I want to hedge like what might be a significant event, on a day like that, I'm probably not using zero DT. I'm probably using something further out.
Yeah, and it's hedging the known unknowns is when you don't go to zero DT. And the last time that we saw an event really like this is there's been a few geopolitical conflicts. But if you go back to the March banking crisis, right, of 2023, you can see here that zero DT really evaporated or decreased. And the reason is because everybody knew that the banks were on the ropes, right? You didn't know when and if a bank would go down. So you can't buy zero DT against that. You got to buy like a 1 month, 2 month, 3 month option to hedge yourself. And that's the same situation here. Is the yen carry trade unwind and all of the related offset effects here of correlation, blah, blah, blah. Like, are we really going to go much lower? That's not a data point I could hedge, right? What we did see of the big zero DT flow is call buying on the open. And so if you do own a longer dated put and you can't close it, you can buy zero DT calls as a delta hedge in the short term, right? Because that way, once the market opens, you buy a zero DT call. And if the market rallies, well, your long dated put's going to get hurt, but you bought this zero DT call to kind of hedge out that position on the day, right? So you could kind of lock in some of your put gains using zero DTs. And we did see a lot of that flow suggesting that zero DTE, quote unquote, bought that dip hard on Monday morning.
Yeah, what's interesting too, and I'm probably getting outside of my area of expertise here, but I think people have argued that zero DTE makes made the VIX. The VIX does not reflect, the zero DTE is not reflected in the VIX. So like the VIX wasn't as accurate as it could be because so many people were using zero DTE. But then we saw it go the other way now. We saw people using the options further out and we saw the VIX go crazy.
Yeah, and you're exactly right. The day this goes to zero or low, zero DT volume goes to zero and VIX goes to 65. That's not a coincidence, I don't think. Like they both got exacerbated maybe by some of the liquidity issues and calculation issues, but the trend of those two not acting inversely correlated, I think makes a ton of sense. I think that the zero DT volume where it was stabilized at above 50%, again, was a function of, trades that had been working very well, correlation trades and the like, and people can count on, hey, the last 20 days, this is what the relationship between the S&P and NVIDIA has been. So let's continue this trade that's been working well. And now that trade is not going to work as well, right? So this 50% plus volume being the standard of zero DT percents, I think is is probably not going to stick around here for the next month or two.
So in this next slide, you get at what I was asking about before, which is this calls minus puts.
Yeah, so this isn't a put call ratio. This is just total net call volume minus put volume. And this chart goes back to Jan of 21. Only January of 2023 did this go lower. And so, this is obviously a pretty significant event. And this is January expiration always will cause weird things to occur in the market. So, puts dominated this past week, both the buying of puts and the covering of puts. Call volume tends to not be that great in these big drawdowns because you don't want to buy calls in a very high volatility environment because the calls are very expensive. So if the market rallies and implied vol comes down, that's a tax on long call positions. Additionally, you don't want to sell calls in this scenario, though, because obviously the market can rally rather violently. And so up until Thursday or Friday, we didn't really see much in the way of call activity. Thursday or Friday, we did see it pick up. I'll talk about that in a second. But, we went from extreme call volumes to now kind of, quite extreme put volumes. We talked on this before. This is S&P term structure, and this shaded cone is 90-day range of this thing. And so, term structure for the S&P was way higher than this earlier this week, but now we're at the top of this 90-day statistical range. And my point on volatility mean reversion is that, those huge volatility shifts higher have now completely reverted, and we're likely to stay in a higher volatility regime now because of these upcoming data points, specifically PPI, CPI, retail sales. That's all this week. OPEX on Friday. Then we turn to VIX expiration next week with FOMC minutes and Jackson Hole. And then we shift right into NVIDIA earnings. And then right after NVIDIA earnings is the September, mid-September FOMC, which is, the most important FOMC of our lifetimes. So, there's not, vol's going to hold what's called an event vol premium for these data points, right? So we'll get, okay, if PPI is okay, vol come down a little bit, right? Short-dated, but then we got to look at CPI. So there's these rolling risk issues here. And I don't wade into the macro perspective here, Jack, but I'm going to fast forward to this, macro and focus in my August path on something quickly here. Over this past week, we went from 100% in a 25 basis point rate cut to 50%, sorry, let me restate that. So we had 100% September rate cut was the market was pricing in of 25 bips. Now, all of a sudden, it's 50-50 that we're going to get a 50 basis point rate cut or a 25 basis point rate cut. There was that Wharton professor, everyone's kind of, unfortunately, he's the brunt of a couple of jokes saying we need a 75 basis point rate cut. Because all of a sudden people are saying there's a recession and we're all in trouble. I think like Airbnb earnings were really bad as an example. And so all of these upcoming data points are going to be, about inflation, which, hey, if inflation is coming down, that's good for small caps. But if we're getting into the recession, do you want to own small caps as a rough example? I don't know that that's a clear answer. You can check your favorite macro guy for that. My point being that so much of what was happening that was a driver of low correlation into this period was, hey, equities are doing great. Rates are in this stable environment. At some point, we'll get a rate cut. We get it. But, I really want to own semis here versus S&P or small caps because, that's what's leading. And that's what I want to make as much money I can in the equity space, right? As opposed to how do I preserve my capital, which is, I think, what the environment is shifting to where, you can say, hey, do I want to own equities at all right now if rates are going to, get cut substantially? Or am I trying to jump into fixed income because there's still some yield there. And if rates get cut 50% or there's a recession, I need to own, bonds over equities, right? So I think it goes from this kind of like inter-equity correlation that everyone's paying attention to more of a macro bonds versus equity correlation.
Yeah, and we've put in certain uncertainty into the picture here. I mean, that payrolls report brought some uncertainty in, which is probably to your point, we're going to see more volatility around these economic announcements now as people try to figure out what's going on.
Yeah, the jobs number, that's exactly what was escaping my mind. Thank you for that. I think by and large, small caps are more recessionary sensitive, are part of the economic cycle. But again, I'm speaking on my depth there, so I'll stay away from that. We had a chart here that I wanted to finish with on this point was, and this is, I think, what the view is kind of going forward. And this seems like a little bit of a macro topic here, and it is, but from the options flows, this is just what I'm thinking I'm seeing is this past week, everyone was making the joke that 60-40 performed great. And so here's the spiders. Was down 4% over the last month versus TLT, which is the long U.S. Treasury ETF. that was up 4%. So 60-40 did great in this past month. 60-40 was dead up until last week. So this speaks to that, equity bond rotation versus the equity allocation, so to speak. And I think coming out of this next month, when you got, all these inflationary and economic indicators printing, and then Jackson Hole, people are going to be coming out of, I think, going into September, really having a focus on macro. And then, of course, you're going to move immediately into the elections, which always keeps the vol premium as well. So, this era of, 15 and below VIX, I think is probably behind us in the short term. And our call has been, I think VIX stays sticky around 20 through this as well. And lastly, just to give another view going forward. So this is what we'll be covering in the next equity expiration. These are our gamma curves from a new proprietary tool that we have. I've been beta testing this, and I wasn't ready to kind of show this to the world, but the data in here has been so valuable navigating last week and given the environment, I want to show this. So this is our gamma curve here in black. And the key here is that the more positive this is where the big resistance is in the market. So right now that's at 5,400 to 5,450. We see a lot of what's called positive dealer gamma. And that is a big resistance area for us into this next week in particular. And then, out of Jackson Hole, we'll see kind of what happens. So because of this dealer gamma situation, as the market rallies, we're going to see people likely selling calls into that in the short term. And that means that dealers will be selling rallies and buying dips. That really kind of squashes volatility and keeps the market pinned in that area. So this 5,400 to 5,450 into kind of Jackson Hole is really what we're watching. And then to the downside, what you can see is when this black line goes into what's called a negative gamma position is where risk really picks up and volatility really picks up. And what's interesting about this is that there's not a lot of negative gamma now until you get really under 5,200 in the S&P. So that's, where, we'd have a really major shock to the downside, I think. But that major shock to the downside is, a function of a longer term trade. In the short term, if we break 5,300, there's this kind of like slipstream area to about 5,200. So in our notes this morning wrote, look, if we break 5,300 to the downside, we're looking for 5,200 to get tested, and then we'll probably trough in there a little bit while we wait for another data point to come along, right? So, there's a lot of instability, I guess is how I would take it, under the 5,300 level in the S&P 500. We don't think you should be naked long of equities under 5,300 in the S&P. Look for some type of hedge at least, right? Or make some downside bets in the option space to bet on more volatility.
Am I right in saying, because this is usually the case with these round numbers, am I right in saying that below that there's probably big support at 5,000?
There is not in this case. There was, because there's so many positions there. So I would look at that as being a support and resistance line because there's just so much options activity at that level. If we broke 5,200, I think we would go down to 5,000 pretty quickly. And then, as you can see, this black line starts to really drop, and that's sort of like the abyss down there, right? So I do think 5,000 is a support level because of the size of options positions. But as far as the gamma lens specifically, there's not a big increase in positive gamma at that level, which is why I say, I would be a little more speculative on support there. The other interesting thing here is this is that same gamma curve from last Thursday, right? So I compared them. So what you can see is all the positive gamma was up near 5,500. Remember, we said when we broke 5,500 last Thursday, things just hit this slipstream, right? And we went down to 5,100, which is where this troughs and stopped. And so what's the takeaway here is we lost a lot of puts. Puts were closed, which is why this yellow line shifts up to the black line, meaning negative gamma went from -2 billion per 1% move to 0 at downside strikes, which tells us that people just closed puts up. The second thing is they sold calls when the market rallied. So the position of the market right now is they're short calls over 5,400 really, which is saying, hey, I don't think the market's going to go up that high anymore, but we're also not long puts anymore because vol was kind of high. We closed up our put positions. Some short puts got closed, and we basically removed that downside flow. So if there is another trigger of, hey, we got to worry about a recession or downside, I'm expecting a lot of people to start to buy puts or reinitiating puts because I don't think that the market's all that well hedged at the moment. And then the same thing from the VIX call perspective. There's what looks like a big VIX short call now at 21, which I think will be removed into VIX expiration next week. So I don't, unless there's a big standard deviation miss in CPI or PPI, I think the market will remain fairly stable and we'll just take it as a vol event. But there is this fairly big VIX 21 looks like call position. And so dealers right now have actually a pretty favorable position in terms of risk if the VIX spikes. That's why this black line's above zero. Whereas heading into the event, which is the yellow line, they were in a situation where they were going to have to chase to hedge volatility if it spiked. So they're not really in that position anymore in through next week. And then next week with VIX expiration, we're going to remove a lot of positions that will allow the market to get a lot more volatile, really into Jackson Hole. So, the takeaway here is I'm expecting a pretty calm week, really through kind of VIX expiration. And then I think after VIX expiration, that's where things can start to get a little bit wild again. Obviously barring some type of multi-standard deviation miss in PPI, CPI, or retail sales.
So yeah, this is great. We even got it in under an hour. We had our longest one last time. We're still on the longer side, but I think there was so much good stuff this week, and it's just interesting. I mean, this thing came up so quickly and was so violent. Like for people like me who are outside of the options market, like I think we're trying to make sense of this. It's like figuring out what happened. And sometimes these things, like it's like, did somebody blow up behind the scenes? What's going on? Like, is there something fundamental here that's going to carry forward? And it just seems like there's so many questions. And I think looking behind the scenes at what's going on here helps us to maybe find out what the answers are, at least partially to some of this.
Yeah, 100%. And I think, that's what my hope is that we could easily identify all these imbalances. We had started talking about these imbalances back in April, right? And so the reason I bring that up is because the imbalances were there, and a lot of times they were worsening or becoming more extreme, and you don't know the trigger. And I think that's oftentimes is that you get one of these triggers that comes along that no one was looking at. In this case, with the yen carry trade. And then you get, the flows that have to get unwound, and you can see them being unwound in the options market, right? And the vols and the positions and all that. And so when you know that, you can have a more level-headed assessment of what actions do I need to take, right? So on a Monday morning, what do I need to do? Why did the VIX hit 65? Is the world really ending, or are these flows exacerbating that? And, should I play a bounce, or should I sell vol, or how do I handle this? And I think when hey, people were forced to cover, that's a different trade than, hey, a bank is going down. We don't know which bank, and there's a systemic risk here, right? And so, that's the point of watching the options market and these flows, is because you see the manifestation of the positions. If people really are scared of a recession, they're going to buy puts, and you're going to see that show up in the market as a very basic example. So, I hope that it's helped everyone to navigate these last couple of weeks, and there should be some very interesting signals here starting to form over the next couple of weeks looking forward.
Yeah, and for your average investor, I mean, the Brent Donnelly had a really funny chart on Twitter where he was showing like all these big VIX spikes, 50, 60, and all of them had like this major event associated with them. And then the last one, he put slightly weak payrolls.
For this all that chart, that's right.
Yeah, and it just gets at the idea that like your average investor is being like, what the hell's going on here? Like,
right.
This doesn't make any sense that it spiked to 60 on something, I mean, the yen carry trade, but it's just not the type of event your average investor would expect to see a spike to 60 on.
That's right. And if you said, if you erased that and wrote, hey, look, the worst breath we've ever had, or, if lowest correlation we've ever had, VIX beta at 0, like I could list on that chart 50 things that were incredibly strange in positioning that you suddenly be like, oh, okay, VIX 65, suddenly I get it. So maybe I should go and revise Brent's chart, one Brent to another.
It's almost like the pre-existing conditions were such that it wasn't going to take a massive event like that to get the 65 spike, because of all the weird stuff you had talked about that was already going on.
Yeah, and this is a new environment in terms of options space, right? Record options volume has only been around for a couple of years. Zero DT has only been around for a couple of years, right? So these are new, a lot of new phenomenons, and we are in a very derivatives-heavy market, and I think things get unwound very quickly, and so you see these huge spikes and these huge jumps. And, the other thing that I think is the red light that people need to pay attention to is that liquidity evaporated in this situation, right? And I think that is, that's going to be the hallmark of the next crisis here, where we're going to get something that actually is a sustained issue, and that liquidity may not be there for a couple of days as opposed to just, okay, for a few hours, like we don't have liquidity, right? And I think that is a real risk that people need to be aware of. Things are very fragile. I think, they have perceived stability, but when you have the options market be such a huge function of what people are trading, or huge amounts of what people are trading, when that liquidity evaporates, like it is really gone in a way that is, I think, unique.
And that's what worries me is just as a long-term investor, and I'm always a positive guy and not a doom and gloom guy, so I don't want to be that way. But like what worries me, like is with these pre-existing conditions, like what happens if China invades Taiwan or something? Like what if you get a major event? Like what does it look like then if it looked like this based on what we saw?
Yeah. Yeah, you're totally right. And but at the same tone, like if you know that this is what the issue is, right, and that will maybe prevent you from selling in the hole, right, on Monday morning, and knowing like, hey, the reason that this is dropping and I can't explain is because liquidity stinks and the options market's driving this thing, and I think Nvidia stock is value at $90. That can help you make a better, more level-headed decision, I think, if it's just sort of the positioning aspects of what is causing some of the chaos. I think that could be a valuable lens to see things through, oftentimes, because a lot of these moves, people don't get it, like the Brent Donnelly chart. I'm not speaking, poorly about Brent. He puts a lot of great content, but to his point, it's like, I don't understand it. And if you don't have our lens on the options market, you're not going to understand it, right? Just like I don't understand a lot of how people are going to navigate rate cuts and recessions and all that stuff going forward. I'll leave that to the other Brent to figure out.
Yeah, I think he was posting it mostly as a joke because it was
totally a joke.
It was a very funny thing. Yeah, like
it's funny because I think a lot of people are like that. Like, I don't understand why the VIX is at 75. Like, what is going on, right?
So I think that's a good note to wrap up on. You said the slides are at spotgamma.com/OPEX. Is that right?
That's exactly right. So OPEX, you can go over there and grab these slides, and we'll be producing a lot more OPEX content this week. So please come check us out for that.
All right. Thank you, everybody, for joining us, and we'll see you next time.
Thanks, Jack.
This is Justin again. Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
The opinions expressed in this podcast do not necessarily reflect the opinions of Volatility Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital.